This is my 5th video and I'm slightly starting to get the hang of this, slightly. Now, this video is all about interest rates. This is my 5th video and I'm slightly starting to get the hang of this, slightly. Now, this video is all about interest rates. If you don't understand interest rates, you most probably don't understand the financial markets. Interest rates move stocks, property, gold, Bitcoin, currencies around the world, and even your monthly mortgage payment. And the reality of it is most people don't even know how they actually work. So in this video, I'm going to break down what interest rates really are, why central banks change them, and exactly how they affect your property, stocks, gold, and Bitcoin. So sit back, relax, and plug in. So let's actually look at what interest rates really are. So it's plain and simple. An interest rate is the cost of borrowing money. When rates are low, money is cheap. People borrow more, business expands, and assets prices go up. Now to the flip side, because there's always a flip side, when the rates are high, money's expensive, the borrowing starts to slow down, spending slows down, and asset prices struggle. Here's the key to all of this. Central banks like the Bank of England or the Federal Reserve raises or lower rates mainly to control inflation. Now, if inflation is too high, they'll simply raise the rates. And if the economy is weak, they'll cut the rates. Think of interest rates as temperature control for the economy, basically. If it's too hot, they have to cool it down. If it's too cold, they have to heat it up. Now let's see what happens to these different assets when they're affected by the interest rate. Let's start off by stocks. As we know from the previous video, stocks represents businesses. Now, businesses rely on borrowing, consumer spending, and investor confidence. Now, when the interest rate goes up, borrowing becomes expensive, companies start to make less profit, and future earnings becomes less attractive. And what tends to happen is investors start to shift their money into safer assets. And because money is going into safer assets like bonds, what tends to happen is the market starts to struggle. And when I say the market, I mean the stock market. This is why high growth companies suffer the most when rates starts to rise, because their future profits are being discounted heavily. Now, when the rates goes down, borrowing becomes cheap, companies expand, investors starts to take a bit more risk, and the stock market usually rallies. This is why during periods of rate cuts, we often see market bounce and recovery. Over to property now. By the way, I'm going to be making a video about how to purchase a property under a business and the benefits of doing so. Now, property is extremely sensitive to interest rates. Why? Because most people actually buy properties using a mortgage. So when interest rates start to rise, mortgage payments increase. Fewer people can afford homes, the demand starts to fall, and the price of the property starts to slow down. So if you're on the variable mortgage and the interest rate goes up, you're going to pay that difference. And what tends to happen is that reduces buying power. Now, you could clearly see how this starts affecting the economy, because everybody starts spending less and the economy starts to slow down. Now, what happens when the rates fall? So when the rates fall, mortgage becomes cheaper, more people can borrow, demand starts to increase, and houses price often starts to rise. Now, for people that aren't on the property ladder, that's probably something they don't want to hear, but I'll make a video explaining all of that at a later stage. Now let's move over to gold. Gold doesn't produce income, so there isn't no dividends, no interest, and no rent that you're earning. So when interest rates start to rise, you could basically earn more returns from savings accounts and bonds, and that's why gold becomes less attractive. And that's the simple reason why gold often struggles during any sort of aggressive rate hiking cycles. But here's the twist in all of this. If rates rise because inflation is out of control, or if investors fear any sort of economic instability, then you guessed it, gold can rise because it becomes a safe haven. And anytime there's any sort of uncertainty in the market, not necessarily because of high interest rates, but fear, then gold can go up. And we all know that Fear and greed is what drives the market a lot of the time. Last but not least, how does interest rates affect Bitcoin? Now, Bitcoin moves and behaves like a high-risk tech asset. When the rates are low, liquidity starts to flood the system, and investors, they start to chase risk, and that's when Bitcoin starts to rally. This is what happened during 2020, 2021. When rates rises, liquidity starts to tighten and risk appetite starts to fall, and then Bitcoin starts to drop. Bitcoin is highly sensitive to liquidity. It thrives when money is cheap. There's even been situations where people have borrowed money to put into Bitcoin. Now, over the long term, many people argue that basically Bitcoin benefits from currency displacement, inflation fears, and loss of trust in the fiat system. But let's look at the bigger picture, and here's what you need to understand. Interest rate don't just affect one asset. They affect the cost of money, liquidity, risk appetite, inflation expectation, and currency strength. And when rates rises, stocks, property, gold, Bitcoin, they start to fall. That being all said, all I'll say is this: if you understand interest rate, you basically understand the engine behind the financial market. And once you start to understand the engine, you stop reacting emotionally and you start to think strategically. This is the end of the video. I hope you enjoyed. You gain a lot of knowledge from this. Like, subscribe, even share.